Hello, my dear students. I hope you are fine. So, this is the second chapter of risk and insurance. The first chapter we did risk defined, about uncertainty, about peril, types of hazard, classification of risk. If you have not read the first chapter, I strongly suggest that you read it once before coming to the second chapter. So we have already covered what is risk, what is peril, what is hazard, types of risk, what is objective risk, what is speculative risk, what is subjective risk, what is fundamental risk, what is personal risk. All this is covered in the first chapter. And please, my name is Dr. Neeraj and I'm working in Bolivar University as associate professor. So please be sure that at least my class, it is must that you are thorough with the first chapter. And now we are coming to the second chapter, and in this we are going to talk about risk management, objectives of risk management, steps like risk identification, risk measurement, selecting the appropriate tool, and risk administration, implementation. So these are going to be covered in the second chapter. So let us start this particular chapter, second chapter. Now guys, the important thing is that first of all, let me introduce about my channel a little bit, which I generally do. It is about management concepts. I also have leadership theories covered in this, motivational theories covered in this. And if you want to know it in a simple way, you can please see those videos. And if you like the content, if you want to get update, you can subscribe my channel. And also I am talking about many things in research, and our software I have put many tutorials. So it is like all about motivation, leadership, risk and insurance and management subjects. Also it is about our research software. I have put many statistical videos in this. If you are interested in research, that is also covered in this particular channel. If you like to be updated for these contents, please follow me. Now chapter number 2 is risk management and the process used to systematically manage. Now it says pure risk. Exposure is known as risk management. Generally it is pure risk. In the first chapter we have covered what is pure risk. Students, what is pure risk? Okay, the pure risk means that there is either no loss or loss. As against speculative risk, which also has profit, pure risk has no profit margin, no profit concept. Pure risk is about either loss or no loss, like death is a pure risk. Now let us talk about definition of risk management. So that's why I'm saying that if you have not studied the first chapter, please study it. And risk and insurance is a conceptual subject. If you understand it, it is very easy. It's nothing. Everyone can score. But if you don't listen, if you don't study, then only God can save you. Really. It is not a subject which you may, but it is difficult to just see the handout and just understand it. Little bit inputs if you take is better for you to understand the concept. So please focus from the beginning and you shall get what you want. Always you are coming for A plus, B minus, C plus. If I give some, I don't want to give low grades, please. So please study and everyone can get A plus. There's not a problem for me. If you perform, there's no problem. It's basically performance. If all are A plus, I have no problem. But if you are not able to deliver or you're not able to write the concepts, then the problem comes. So try to understand if you want good grades, which you want, I know. So, students, what is the definition of risk management? Risk management is defined as a systematic process for the identification and evaluation of loss exposures faced by pure loss exposures faced by an organization or individual, and for selection and implementation of most appropriate technique for treating such exposures. So we can think of risk as a problem. So what is risk management? So risk management is let me go to the slides which are important. So what is risk management process? Identify the problem, that is the loss. First you identify the loss. First you have to identify the problem. If you identify a risk or a loss or a problem, half problem is solved. First you have to identify what is the issue. Where is the issue? Where is the risk? Identify that. Think as a common sense. No need to rectify it. Rectify means in Hindi I am saying no need of memorizing it. That will not work. Little bit memorizing is important, but think logically. If there is problem, how you will solve it? Tell me. First you will identify the problem. You will identify the loss, potential loss. You will identify the risk. Simple. Without identifying, you cannot solve it. First you have to identify what is the issue. For example, your weight is increasing. First you have to identify that your weight is increasing. Until and unless you identify that there is a problem, you cannot solve it. Some people have short temperament. First identify you have a problem or not. But if you ask those people, they will say, no, we are very cool-minded, we are very smooth, we are having no problem, we are having we don't get angry. But as an observation of others, they get angry for small things. So sometimes we are not able to identify the risk. We have to first identify our risk. What is the risk? What is the problem which we can face in future or we are facing? So identification of potential loss is common sense. Second is measuring the loss. How big is the problem? How big is the risk? How big is the loss? Third, selection of risk management tool. How to solve this particular problem? How to solve this issue? Like what technique you will use to reduce your weight? Weight was the problem. Measuring the problem. It is I am overweight by 30 kilos. Selecting the risk management tool to overcome that. This weight has to be reduced. What technique you will use? Either you can go for dieting, you can go for exercising, you can stop taking oily food, you can stop sugary items. So what tool you will use to solve this issue? And last is implementing the best one. Okay, I will do little exercise and I will not eat oily food or sugary food. So this is implementation and monitoring the decision that whether this is working or not, your weight is reducing or not. So I have given you a journal example, but we will understand this in terms of risk and insurance also. So this is what I am talking about. This is risk management process. How to manage the risk. There are how many steps, students? 4 steps. If I ask you in the exam, suppose if I ask you, explain the risk management process, suppose with examples, then what you will do? You will write these 4 steps and then So is it mention or is it explain? Have I said mentioned or I have said explain? Mention means just write these 4 points, Baka. That is all. Explain means you will explain this in 2-3 lines with giving examples. That is explain. You have to describe what it means, the way I was explaining you. So now we go back. Wait. So now where were we? We were, definition of risk management. And what is risk management? Risk management is a process which has 4 steps. Now, what about objectives of risk management? Risk management has pre-loss objective and pre-loss and post-loss. Pre-loss means before the loss has occurred, and post means after the damage has been done. So pre means before the problem has occurred, before the risk has damaged the company or a person for that matter. Pre-loss objective: an organization has many risk management objectives prior to the occurrence of a loss. Prior means before. The most important of such objectives are as follows. The first objective, that the firm should prepare for potential losses in the most possible economical way. It should prepare for the problem to be solved in which the least bit of rupees or any dollars is spent. With least number of dollars to be spent, you should be able to take care of your problems, this risk. That is the first objective. Obviously, you have to save your pocket. You have to reduce the cost for solving the problem. That is common sense. Second objective is reduction of anxiety. Because loss has not occurred. Oh, the fire can happen in our factory, earthquake can come. That creates anxiety. Anxiety means stress. So if you are able to have this risk management process, risk management in place, and it is done properly, then what will happen? Your fear will be reduced, your anxiety will be reduced towards that loss, because you have planned it. If this happens, we will do this. If this problem comes, we will solve it like this. If you already have a plan and with the organization, then obviously the stress, the fear will not be there. Like for example, it says a lawsuit can come for a defective product. That unnecessary fear is there. You can solve this beforehand by taking a indemnity policy or professional indemnity policy or something like that. That we will discuss in the in the chapter which talks about different types of insurance. So this is what the second objective. The third objective is that there are certain external imposed obligations you have to take care of beforehand. What can that be? Example: some safety devices are supposed to be there to protect the workers from harm. They should be in place. Safety devices to protect workers, like helmet is mandatory, so that accidents are less. Helmet. For fire, extinguishers are there. In case there is fire, the fire can be stopped immediately by the extinguishers, those small cylinders. Like this. That is pre-loss. Before the loss, you are prepared. Post means after. After the loss has happened, after the risk has happened, like fire happened, theft happened, like that. After that, what is the objective? Survival of the firm. The fire has burned the whole factory. Survival is the first post-loss objective. At least it should be operational. The firm should be able to continue its operations. Continue the operation. That is a survival, part of survival. Stability of earning, the per share earning, that means the earning should not drop, which is very difficult, but it is saying here it is saying it's difficult. Another is continued growth of the firm. Now it is going step forward. First is stability of earning, like it should be constant, but it should also maintain the growth curve, which again is more difficult to maintain, but it can be done to quite an extent if your planning is there. And the fifth one is social responsibility. What will happen to the employees if the factory closes or the operations are stopped for some time? You have to take care of their families. You have to take care of their salaries. You have to take care of their medical requirements. So please, this is also an important social aspect. Our risk management process. Again, we have come back to risk management process. So what is the process? There are 4 steps. The first one is identification of potential losses. So identification of potential losses, we have to say what property can be damaged, property loss, like factory, head office, assets, business income losses. What income generation will stop because there is no production that time. If there is a fire, suppose. Liability losses. Liability is what? I think I told you in the first chapter, but still liability is, it can be director's liability, it can be a professional liability, it can be a liability to the organization for producing wrong products. Third party liabilities is there if there is a motor accident of the organization. Suppose organization car hits to some other person outside the company, then that person will put a third party liability case on the organization for claiming the death of the person or hospitalization expenses can be recovered by that affected person. So that is called third party, which I will teach you in the motor insurance. Death or inability of key people. Somebody dies, like director dies, there is something called as key man insurance to protect that. The main person without whom the company will not run, because he is very important for decision making and he is no more. So that will create a problem that is a loss. Job related injuries, like somebody loses his limb by accident, such kind of injuries we are talking about. Fraud, criminal acts, dishonesty of employees. We also talked about moral and moral hazards, if you remember. So one of them is fraud, criminal acts, dishonesty of employees. That moral is with reference to insurance, but here also, for company also, the fraud can happen. A person can create issues for the organization. Employee benefits will get affected. How you will take care of that? Like suppose you are giving medical insurance to the families. Will you be able to continue? You should be able to continue. You should have funds for that. Physical inspection of company plants. So now the thing is, a risk manager has several sources of information. How you can get information about these risks? First is by inspection. Second is by questionnaire. Why questionnaire is important? You can inspect and find out everything. Why questionnaire? Because when you are asking a concrete question, many things will come out which are not observable also. Because people who are working in the factory, they know inside and outside of everything. They may not be freely speaking, but when you ask them in the form of a questionnaire, they will give you the hidden information. Flow charts. You have to see the flow charts. Where are the problems? Where are the bottlenecks? Where losses can happen? Financial statements, they are very important to see which is the most costly asset you have. You have to protect it first. Then the historical claims. What claims are there which happened in the last, say, 10 years, 15 years, 20 years? Those claims. What kind of, losses we have occurred before. Sorry, that can also help us. Now, next is evaluation. Second point is evaluation. Second step in managing the risk is evaluation or measuring the losses, which is in the fourth step it is saying measuring the losses, or we can say that evaluation of losses. First is, what is the first thing? What we are doing, this is a process of risk management. First step is what? Identifying the problem. First we have identified. Now what we are doing? Now we are going to measure the amount of problem, measure the severeness, how severe it is, how important it is to be that particular risk is to the company, so that once we know the importance of those risks in a particular order, we know that at least these risks which are very critical have to be insured. That's what we are doing. Now we are measuring the risk, which is most important. Which is the most important risk for an organization? A risk which will stop the organization immediately, which will damage it, which will make it non-operational. That is a very big risk for the organization. The risk which will damage the financial position of the organization, which will make it non-operational very fast. That is a risk which we are looking at to be covered first. Others also will cover, but we will cover the first which are having high impact. So what is that? Evaluating the measuring the potential losses. The second step in the risk management process is to evaluate or measure the impact of losses on the firm. This involves an estimation of potential frequency and severity of loss. This involves an estimation of potential frequency and severity of loss. What is frequency? Number of times this particular risk has happened. Number of times the burglary has happened, theft has happened, that 100 times it has happened, or it happens once in a year, once in 5 years, that is frequency. Second is severity of loss. When this burglary happened, what is the amount of loss the organization has to, what impact it has on the organization with that particular loss, financial loss. That is severity. If the loss is more, severity is high. So frequency and severity. But when you see these two parameters, frequency and severity, as a risk manager, severity is what you have to look more. More importance you have to give to severity, not the frequency. Frequency is also important, but severity is the first parameter you will look at. So now it is saying that various loss exposures can be ranked. Now there is a concept of maximum possible loss. Okay. Maximum possible loss. Let me try to do something here. Yeah, you can see it, maximum possible loss and maximum probable loss. Maximum possible loss and maximum probable loss. What is this maximum possible loss? It is talking about severity. And maximum probable loss, we can say it is talking about frequency, maximum amount, probability, chance. Now there's an example, it's good to see this example. If a plant is totally destroyed by flood, the risk manager may estimate that the replacement cost will be, say, $10 million or birr or rupees. The maximum possible losses in this case is 10 million birr. First of all, let me thank Department of Management for giving this material to me. I forgot to say in the initial stage. It is from the Department of Management. I thank the department for this material from Volga University. Now, removal, okay, this is $10 million. That is the maximum. If some fire happens or flood happens, everything is destroyed. 10 million is the maximum possible loss. That is maximum. Then what is it saying? The risk manager also estimates that the flood causing more than 8 billion birr, previously it was 10, now it is 8 million birr of damage is unlikely. In 30 years it has not happened. In 30 years once only happened that 10 million was lost. Generally it is 8 million. So maximum probable loss is 8 million birr in this case, because probability, chance is taking. 10 million will never be. 30 years nothing happened now, or maybe 50 or 100 years it can be that nothing happened. In 100 years 10 million has not been lost. So he may not consider this 10 million, he may consider 8 million. The frequency is very, very, very less. Probability of loss is very, very, very low. So he will take 8. Because for 8 it is chance is very high. Maximum possible loss of 8 and the chance also high. He may consider 8. Selection of risk management tools. So what are the various risk management tools? See now where we are in the third step. Please understand. The first was identifying of the risk or problem. Second was measuring the risk in terms of what? In terms of frequency, in terms of the volume, amount, severity and frequency. We measure it. Why we are measuring it? So that we can rank it, the highest risk to lowest risk in terms of frequency and in terms of the severity. After we have done that, we go to the third stage. What is that third stage? Selection of the appropriate risk management tool. Risk management tool will be selected based on the priority which we have made. So let us see. Risk control techniques can be avoidance and loss control, and risk financing techniques are retention, non-insurance transfers and insurance. Avoidance and loss control are risk control. This I have already told you. So what is avoidance? Risk control techniques are avoidance and loss control. First we are seeing risk control techniques. First is avoidance. What is avoidance? To avoid it. It's better to avoid. Why it has to be avoided? Because, like for example, it is difficult for us to insure it. Exposure is high and insurance will not be able to cover that risk. Like for example, if there is an earthquake prone area, it's better not to make factory there, or there is a flood prone area, water is coming always, every third day there is a flood, then it's better to avoid that area for making a factory or a production house or any office, because that area is prone to risk. That is called avoidance. We don't want to be, we can avoid it easily by selecting an area which is not near this particular place where floods are coming very often. So that makes sense. What is loss control? Loss control deals with an exposure that the firm does not want to abandon. We don't want to lose it. We want to control the loss. Example. By example, we will try to understand. Measures that reduces the loss of frequency are quality control checks. By quality control checks, loss will be controlled, surely. Driver examination. Driver is driving properly or not, loss will be controlled. Strict enforcement of safety and improvement in product design. If the product is better quality, design is better, the chance of damage will be reduced. Like for example, if your car is having a better design, the chance of that particular car to meet with an accident, because design is good, the chance of it tumbling down on the curves of the road is less there. So the design matters. Because of that, the loss may be reduced, will be reduced if it is done properly. This is loss control. That means by taking some steps, we can reduce the losses. For example, fire extinguishers are there, those cylinders. This is also a loss control. You can stop the damage. The severity of damage will be reduced by taking some additional steps. Next is retention. You retain some risks. For example, if there is example, it's better to tell. Yeah. Firstly, the losses are highly predictable when you are, retaining the risk. For example, workers' compensation claims, physical damage, losses to automobiles. So these are something which are predictable. Like physical damages, losses to automobiles. Previous, we have a motor, we have a service car, we have a car. In last 10 years, what are the damages? We know it. So we can retain those risks which we know. Especially suppose a car is moving inside the university or inside the organization, then what will happen? We know what kind of damage it can have. It will be less, frequency will be less, severity will be less, if at all it happens. So we can retain that low risk car risk, accident risk. So this can be retained. So how to say how much we have to retain this risk? How much is the value of the retention? It can be 5% of the earnings, or it can be in terms of percentage of firm's net working capital. Some percentage of finance we can retain, because what is retention? We have to pay from our own pocket. That is retention. What is the advantage of retention? We don't have to pay premium to the insurance company. Car is moving inside the campus, inside the organization. Why we have to pay premium so much? We can retain the risk. First year it is mandatory in 99% cases of the world. Second year onwards you may. The services provided by the insurer may be provided by a firm at a lower cost. Yeah, sure. Cash flow may be increased because you don't pay premium to the insurance company. What is premium? Please see the first chapter. The amount of money paid to the insurer by the insured to get the risk cover. That is amount, that premium, that is the cost of insurance. Retention is only one disadvantage. Big disadvantage is that it may be the losses may be more than the capacity of the organization. Losses have come more losses are there, but where our funds are less. It can happen. It's dangerous. Next is non-insurance transfer. What is non-insurance transfer? That I am making mobile. I have given the contract to another organization to manufacture because my orders are very high. So I give the know-how to the other contractor and he will make on my behalf the mobile. But I tell, or a medicine for that matter. But I say if there is any defect in the medicine, if there is any defect in the mobile, any claim comes from the customer, you will pay. That is called non-insurance transfer. That means it's not an insurance, but the risk is transferred from me to that the other company because they are making on our behalf. So that is a good advantage. We don't have to pay premium also for that. What is the disadvantage? Finally, it comes to me. If he is not able to pay, suppose the other company is not able to pay, what will happen? The brand is mine. Customer will put a legal claim finally on me. I cannot excuse myself from the liability of paying the amount. In case he fails, the other company on whom I am transferring the risk, because their financial capacity may be low, or they may close down, or they may run away, because they don't care. But finally, the brand name is mine. Finally, the buck comes on me. You can read this, please. Insurance is also used in risk management program. First is selection of insurance coverage. What insurance will cover? What part will cover? Suppose medical policy is there. What all should be pre-existing disease will be covered or not for our employees? We have to select an insurer which claim ratio is high, who is financially sound. Negotiate the terms. Like co-pay will not be given by my employees. What is co-pay? When you are paying a payment, 10,000 has to be borne by the customer. That will not be. That is negotiation. Premium should be reduced. These are negotiations. Dissemination of information concerning insurance coverage. This insurance, what all is covered, should be told to the employees because they should know what are the benefits they are getting. Periodic review of insurance program. It is not a static thing that once you have taken insurance, it is finished. Insurance cover will increase over a period of time as your company expands. Then you have to see what is essential and what is desirable, like what is a need and what is a want. And last is available. There is a need of insurance, but it is not available. Like for example, 85%, 85 age, there is no risk cover. It is essential, but this is what it is saying. First you have to see, is it essential, need, desirable is a want, need and want, need is a must, want is a luxurious items. You can do without them. And available, that means A priority, B priority. And available insurance, whether that risk is covered, is insurance giving that risk or not. You have to see that. This is what is explained in this particular notes. Now last point is risk management tool matrix. What is risk management tool matrix? This is a matrix which talks about frequency and loss severity. First type of losses, loss frequency is low. Frequency is low means it will not happen very often. Severity is low, that means damage will be less. So in this case, what technique you will use? You will use retention. You will retain because I said first see the severity. Severity is low, you can retain. You can pay from your pocket. No problem. Like vehicle insight. Okay. Inside spelling. vehicle inside the factory is having less chance of accident, and severity of accident will also be low. Chance of accident inside the organization will be less, and chance of damage will also be less because it's a short distance. So both are low, you can retain it. Second is loss frequency is high and loss severity is low. It is happening again and again and again, but less money is going. In this we can say loss control, and it can be also retention, but we'll talk about loss control. Like burglary, alarm should be set. If the burglar thief is coming again and again, frequency is high, but he is taking small things, so this will not close the organization. This is not severity is not high, it's low, but frequency may be high. You are in an area where every night every second day something is happening, so some cameras can be put, some alarm can be put, so that loss control will happen. Next is loss frequency is low, third, and loss severity is high. This is insurance. Example, fire. Fire may not happen every day, frequency is less, but if it happens, it will take everything. It can. So that is fire. Fire can be covered by fire insurance. This is an example. Fourth, frequency is high and severity is high. Avoid. Factory setup away from flood prone area or earthquake prone area. Every earthquake will damage the whole thing. Flood will damage the whole thing. Severity is quite high. I said severity, when it is high, you have to take care of. In both these cases, severity is high. Frequency is low or high, but that's okay. But severity is, if it is high, either insurance or avoid. It cannot be ignored. It cannot be retained. Severity is high, it cannot be retained. It cannot work by retention. It cannot work by loss control, because severity is high. It will finish the organization, it will stop the organization, and you will fail in your risk management. So if the severity is high, in these two cases, frequency is high or low, it does not matter. As that severity is high, then it should be covered properly, either by insurance or by avoidance. Why this is avoidance? Why this is avoidance? Because frequency is high and severity is high, even insurance company cannot save you. Again and again, insurance company will not give you claim. Every day flood is coming, they will stop insuring you. So avoidance is must. Thank you very much for your time. That's all.